Hi, everyone. I'm Maggie Lake here with Lukas Kuemmerle, founder and editor of Kuemmerle Research. And we are going to take a look at the supply and demand dynamics around oil and natural gas and try to tease out what might happen to prices in the coming months. Hi, Lukas. It's great to have you on Real Vision.
Hi, Maggie. Thanks for having me on the show. I'm a big fan of the show myself. And yeah, looking forward talking to you a little bit deeper about the commodity and energy sector.
Yeah, and it's a great time too, because we've seen a lot of volatility in those prices. But before we kick off, why don't you give us a little bit of background on yourself and your approach to this, and maybe even correct me on your name, because I'm pretty sure I came close, but I'm not sure I exactly got the pronunciation. So tell us a little bit about yourself.
Yeah, it's not easy to pronounce. My name is Lukas Kuemmerle. I'm from Germany. I live approximately 200 kilometers north of Frankfurt. And I'm into commodity research for about 4 years and provide some reports and thoughts over Kuemmerle Research and the commodity report. And yeah, my approach of judging developments in the commodity market is very fundamental and statistical driven. So I look a lot at fundamentals, but also at technical data, positioning data, seasonal cycles. And because I mainly trade the US futures market, I also have to look at the term structure. So also very important.
So let's start with maybe the price issue first, just so I can see where your head is before we layer on some of the fundamentals, because we've seen some really big oil moves in oil. We know it spiked up to that 130 level after the Russian invasion of Ukraine, but it's come down pretty sharply with some whips in between. I think down maybe 30% from the high. So what do you make of the current price action and the fact that we're kind of sitting below $100, at least when it comes to WTI? What do you make of this price action?
Yeah, if I look at the chart or at the price action, if we see such an extreme spike to the upside, and my experience is usually very emotional driven. And I think the market participants still had the fear that Europe will shut down all the imports from Russia related to oil and gas completely. And I think the market to try to price something like that into the market. On the other hand, we also got some calming reaction when the US government came out and released a statement that they will imply more of the SPR reserves into the market. I guess it was about 1 million barrels per day over a time frame of 6 months. And so I think what actually happened is that the actual pain in the market from a price action point to the upside is delayed kind of into the future. Because what the US is currently trying is to calm the market participants with injecting these SPR reserves. But we should not forget that over a prolonged time frame, these reserves probably have to be built up again. So basically, oil has to be bought back again. And this will, of course, with a high probability, be to higher prices. And if we look, for example, at oil futures, where it's, as I stated before, very important to look at the time structure and the forward curve, we can see that the longer dated contracts, for example, crude oil in 2023, or the end of 2023, are more stable and corrected not that sharply like the forward months. So yeah, I think this is actually what's going on right now and how I judged the situation at the moment.
And are they more stable but at a higher level? Where do you see that equilibrium?
So in the short term, I actually am kind of neutral towards crude oil, because we also see all over the media the recession fears and economic growth and economic slowing conditions are highly correlated with the price of energy and especially oil. And if we actually see continued slowing momentum in the economy, then I think that here is also further price weakness possible. But over a longer time frame, which I would say the next 2 years, I still think that crude oil has lots of more upside potential because we still have structural issues that aren't solved yet in the oil industry. So only to give you some points, is the low capex that is in this sector. So we had structural underinvestments over many years because we thought that we could just switch the button and go from fossil fuels to renewables. But we saw in the past 2 years that that won't happen as fast as we would like it to happen.
Let's dig in. Let's dig into some of those, because that to me falls in these sort of longer term, really specific to the oil and gas industry. Some of these structural issues, and I think they're so important. But if I understand you correctly, it sounds like near term. Well, question on my mind is, what are you paying more attention to, supply or demand? It's always both, right? But what's the lead right now? And it sounds like in the short term, you're looking at demand as an issue. But then you've got, medium to long term, it seems like supply is going to be top of mind. Am I reading that correctly? Do I understand you correctly with that?
Exactly, Maggie. I couldn't put it any better. If we look at supply, especially in the US, we can still see that production is an issue. So we are still not back at the production levels that we saw before the COVID crisis. And we have to ask ourselves how can we get production back to these levels to keep up with demand, because demand for oil will rise even further. My guess is that we will see something like a demand peak in the year of 2030. And till there, we need to keep production at higher levels, because it takes just time to keep renewables at the same level like fossil fuels.
Yeah, that's going to be needed in the transition, even if people continue on the track for a switch to a cleaner or renewable energy source. So is the U.S. when we look at the global picture of supply, is the U.S. the critical, and getting that U.S. supply up, is that the critical factor here? What about OPEC? What about non-OPEC countries? What's the potential or the prospect for a significant increase in supply? What do we have to pay attention to?
Here I have to say that I always mostly look at the US markets because I only trade US futures. That's for me why it's most important to look at US developments. But as you said, there are many more variables we have to look at. You mentioned OPEC, where we can see that OPEC isn't quite able to meet their own production targets. So they have also not the right tools at the moment to meet the targets they have promised. And we can also see that the OPEC is more a friendly ally of Russia. In the OPEC Plus, Russia is another member. And I don't think the OPEC would like to have too much to do with politics. And to keep Russia calm, I don't think that even if the OPEC was able to produce more oil, to insert more oil into the market, they wouldn't really do that to make Russia more angry. So from this side, I don't think we can really count on OPEC here on the production side.
So that if we focus on the U.S., we know that there is the possibility or the potential here. So are U.S. producers trying to ramp up, and how quickly could that happen? What are we seeing?
What we can definitely see is that the drilling activity comes back online. But as I said before, the production level and also the drilling activity is still below pre-COVID trend. So there's still a gap which has to be closed to keep up with demand. And this is definitely, the key question that I see for the next 6 months or 9 months. Will the US be able to increase drilling activity? Will they be able to increase production capacity? Going into the colder periods, it's autumn and winter 2022, when consumers especially are need energy to heat their homes, when demand is higher from the consumers, which is basically in times of when it gets cold in the US. So yeah, over the summer now, not only the US but the whole world has to find a way to increase production, to increase inventories again, and solve that matter.
So what's standing in the way of increased production in the US?
I think it's kind of a bit politics, but also politics from the corporations. As we can see, the companies that right now benefit from higher oil prices, they use these earnings to pay off debt, to increase buyback programs, and to increase dividends, to increase the shareholder value. On the other hand, there's politics like President Biden, who says that oil companies should increase production as early as they can, and those shareholder values, they should be postponed. So the priority should be on drilling activity and increasing production.
Are you talking about the oil majors, like the big oil players?
Yeah, we have some like Chevron, BP. There are many big players, but we see that the focus really was over the last 2 years on reducing the debt burden. And if we look what also happens right now on the interest rate front, on the refinancing front, I also have to say that wasn't the worst thing they have done over the last 2 years.
Yeah, and is that true for frackers as well? Because there was a lot that I remember when there was the big shale boom, and we saw all of these companies, all of these deals, all of this financing, and some of it was at risk of defaulting when we saw, it was maybe excessive. It was too much and it was at risk of default. And there was a lot of pain when we saw oil prices move lower. So have the frackers been using the time? Do you count them in the group, have been using the time to refinance and pay down debt? Or is that just the major oil companies?
Here, I was generally speaking for the major oil companies, but I think the general trend that we could observe over the last decade was that the ESG hype that also was called by governments all over the world led us to declining cash flows in the industry, and investments weren't that good anymore for investors. And therefore the whole industry became less interesting. And we can now see in which difficulties this approach result.
Yeah, on the one hand, you have the big players pouring back money into basically their financing, accounting, giving it back to shareholders, and the smaller players who maybe wouldn't have done that just can't get the financing because of the new ESG regulations and capital flows. What does it tell you about the fact that the major oil companies, though, decided to continue, even when we saw prices bottom, just continue to choose to give it back to share? Tells me that they didn't see the investment was worth it. Do they not believe that energy prices are going to stay higher, or is that conversation starting to shift?
I think they just not believe in government, that their priority will be in further investing into fossil fuels. I think all the oil companies know that their maximum investment potential is already behind them. And the momentum shifted to renewable energy. And I also think that, or it's obvious that these niches are more favored by governments, with also money that is pouring into these sectors. And oil companies basically just try to keep the stocks at a good level for shareholders, as long as they can
keep their shareholders happy. Exactly. So are we seeing, now that we've had these major issues, the major shift in commodities, and I think realization that fossil fuels will be needed to fuel the transition to renewables. Are you seeing drilling activity increase in the US?
Yes, actually, the last numbers were released last week, and we definitely see still a pickup in drilling activity. But as I mentioned before, we're still below trend, and there is lots of to do to keep up with demand. Yeah, but as I said before, I think drillers and oil companies in general have to use the time over the next 6 to 9 months to keep up with drilling activity, to increase production, to get us over the next winter. This will be the key question here for me, which will also drive the price action of crude oil over the next month.
And what about pipelines? Because you can get it out of the ground, but if you can't get it to where it needs to go, and this has always been an issue in terms of getting approval for new pipelines. You have community issues, not in my backyard. Is that going to be a major hurdle, even if we see that drilling ramp up?
It depends. If you talk about pipelines, you know that you have to make a major upfront investment into these pipelines. And if your regulation and government favors renewables over the long term, I doubt that there will be so many initiatives to favor those projects at all.
Yeah, I think that's what a lot of people are concerned about, that infrastructure, and do you get it in place in time to try to deal with this, or is that something on the structural side, or at least the longer term side, that maybe puts a floor under prices? But what, if we flip back to the demand side, there's that old saying that the cure for high prices is high prices, right? Short term, I know you're looking for that to hit prices, but what happens to demand if we're in an environment where oil prices stay elevated? Doesn't that just accelerate the shift to alternatives, to either conservation or electric vehicles or new technologies to optimize it?
I would definitely confirm that view. But we also know that it takes a lot of time to build the infrastructure that is needed. And it also takes a lot of new commodities that we have to get before we can build this infrastructure. So in general, I would say consumers have still to live with higher prices from the oil and gas side over a prolonged time frame. Especially as long as production didn't get increased, and as long as we don't get something like a deal or peace agreement also over there in the Ukraine.
Hard to forecast when you've got that very unpredictable geopolitical situation going on.
Yeah, and that's also where I favor it to be kind of neutral on the crude oil contracts right now. But I'm very optimistic on the longer dated futures contracts. And that's my approach that I'm doing there right now.
The other thing that's awfully difficult to predict is COVID. And even though most of us think about it being in the rearview mirror, we have China with massive lockdowns, COVID lockdowns again in major cities. And China is a huge energy consumer. How is that factoring into your forecast?
China is, as always, a big variable here and a big unknown. We do not only see this problem for oil consumption over there, we also see it in form of freight rates, of port congestion. So basically, the economy over there in major cities like Shanghai is mostly shut off to get these COVID cases under control. But production, the companies, they can't work under full capacity right now, as can't the ports. And this could lead to some renewed stress into the supply chain, which will affect basically the whole world, because everyone is an importer of Chinese goods. What you also mentioned is that the demand side from China in terms of crude oil is affected by this. And of course, when the companies currently can't work on full capacity, they tend to also need less energy consumption. So also something that you could view as a factor in the current price action and why crude oil prices corrected over the last weeks.
Do you think that correction is over, or is there further downside to go before we kind of hit into some of these longer term underinvestment issues that are there?
I'm looking here, to be honest, at the earnings season that will kick off soon, because I really would like to know how strong the consumer actually is. Does the consumer still would like to buy hard goods, or is the consumer favoring services again? So this is an important sentiment check for me to look out right now. And I think this will also kind of benefit the direction of price where we headed next. The other variable we talked about earlier is the question if we see a recession, especially in the US, but also in Europe. And of course, these two variables will drive price action over the short to the midterm. I think that the price action of crude oil will look like something like we see in the last week. So no big movements at all over the next month. Something like a sideways market is my prediction here.
And you mentioned the SPR release before. How will it have the desired effect? How will that work in terms of what we see in prices? Because I think you brought up a good point. They're releasing it, but at some point they've got to rebuild it.
Yes, this is the question I have too. What my take is here is that I actually do think the US has to rebuild these inventories later stage of time. I guess this will be the case in the middle of 2023. And then we have to see where crude oil prices are. But as I mentioned also earlier, I think crude oil prices in the long term will be higher. You know, there are high probabilities that the US has to buy back those crude oil reserves to a higher price than earlier. And for me, this is also the reason why I still benefit the longer dated crude oil contracts and not the short-term crude oil contracts.
Even if you have a recession, if that's the case, we don't know the timing, even if you have a recession or a fall in demand due to a switch to renewables, you've got this kind of constant buyer in there providing support, which is the government replenishing the inventories, right?
Absolutely right. Yeah.
We're also in an environment where we are facing higher interest rates, right? We're in what some people think is a new rate regime. Do you consider the rate environment when you're looking at commodities? Well, how do you see that relationship?
Yeah, especially in oil, we can see that a hiking environment tends to favor higher oil prices. And also an important fact to keep in mind here, the Fed tries to get inflation back under control. My take is also that they're slightly behind the curve. And we will see an aggressive approach by the central bank to get this inflation back under control. And that means higher interest rates, more rate hikes over the next month. And usually this is still a supporting factor for crude oil prices. And this is also the reason for me why I wouldn't be too bearish on crude oil right now, because the fundamental data is still very, very much supportive for the energy sector.
Explain to me why that is. Is there, when rates are rising, it tends to be bullish for oil? Is the assumption that it's because rates are rising because of a strong underlying economy?
This is also the thought that I have on this topic. But I also have to say, in the approach that I do, which is very statistical and probability driven, sometimes there are just things I can't quite explain, but I know that they have a statistical significance. And this fact that we talked about here right now is something like that I would put into this basket as well.
Interesting. Well, then we have to think about things like the dollar and all of these other factors that may be contributing to it. So maybe it's not just the economic link, maybe it's in confluence with something else that kind of creates that bullish scenario. I wonder, how long does it last for, though? Do you have an initial? Sometimes stocks go up too when we first start raising rates until the economy turns over, and then you see that relationship break down. What's the time span? Have you looked at that? That correlates with rising rates and bullish oil prices.
Actually, I haven't, Maggie. I can give you a clear explanation or target for that. But I would like to come back to the currency or US dollar question. We see quite a strong US dollar over the last couple of months. The only currencies that are currently outperforming the US dollar are currencies that are highly commodity performance driven, like the Brazilian real, the Australian dollar, and also the Russian ruble. But in general, we can also say that in the past, we always had this correlation, which basically said if we see a weaker US dollar, this has to be supportive for the commodity markets. But over the last year, this correlation unfortunately broke completely. And even that we see a strong dollar over the last year, we even saw even stronger commodity prices. So this is also an important fact to keep in mind, that this correlation that worked very well over many, many years is currently completely broken.
Yeah, it's which is why so many people are kind of trying to figure out their forecast, because some of the traditional things we've relied on are not moving in lockstep the way they used to, at least. There's a lot of debate about whether the ESG movement is dead, or whether this will accelerate, these high commodity prices will accelerate that. Even if you believe that there will be alternatives, say electric vehicles, for example. I was just with a friend last week, and we were in a Tesla, and they were saying that they haven't had to fill up for gas, so they're unaffected by it. So you could see more people sort of seeing that and moving in that direction. But right now there's not enough to pick up the demand, is there? How are you, when you're trying to figure this out, how do you think about, we talked about the sort of CapEx and investment in infrastructure in the traditional oil and gas space, but for the alternatives to take over, they've got to have a runway too. So how long do you think that period is where you've got to rely on oil prices that are going to continue to get bid, because there's just not enough alternative for people to make that decision?
As I said before, the latest forecast suggests something like 2030 as the year of maximum demand for oil. And this transition to renewable energy, of course, takes a lot of time and a lot of investment into commodities. I mean, you talked about electric vehicles. I drive an electric vehicle myself as well. But we can't say that we are not affected by higher energy prices from fossil fuels, because if you generate electricity and it's not 100% from renewable energy, you basically face higher fossil fuel prices as well. So you're definitely affected by this environment. But yeah, as you said before, the transition towards renewable energy will take a lot of time from a time horizon. I hope that we will be able to reach capacity till 2030 that kind of is higher than 75%, to not be too reliant on fossil fuels, and to put them back into the box and be more reliant on renewables again. But there are many unsolved questions. We need a lot of commodities. If you read about lithium or platinum, palladium, also very important materials you need in the energy transmission, as well as copper. We still don't know if we're quite able to get all this supply and where this should come from to keep up with demand here as well. So it's not like the questions here are all solved, and it will be an easy way to make this transition to renewables.
No, absolutely. You said you primarily play the futures market, the U.S. futures market. There's been some discussion or some wondering aloud whether non-traditional energy participants have been piling into these commodity trades, whether it's a hedge against inflation or just a pure momentum play, creating more volatility in prices and in the market than maybe we would normally see. Do you think there's any merit to that?
I can understand the discussion. We have kind of the same discussion also here in Germany, where, of course, I think much more people are very skeptical towards financial markets and also derivatives. But I see it from this standpoint. If you have a futures contract, you always have one party. So you have one buyer and you have one seller. And if you're a speculator like me, you basically provide the hedge for the commercial player, which is a drilling company, a producer, or an oil company, whatever. So basically, these speculants in the market are necessary to keep these hedges going. So if we as speculators are not there anymore, then my take on this is that commercials would have a tough time to hedge themselves against risks. And so my take is that they're still needed, but I still understand discussion because it's very emotional topic as well.
Market participants providing liquidity, right? That's always the pull on the other side when people talk about this. What kind of energy cycle do you think we're in? Some people, we're going to talk a minute. I want to talk a little bit more and sort of end on where you see value, what time horizon you're using. But do you think that we are in a cyclical move where we're looking at energy prices, or do you think this is a super cycle? Do you think there's something more structural going on now, or longer term? What camp do you put yourself in?
I'm not the biggest friend of naming it a super cycle, because from my investing or trading approach, I basically have a maximum time horizon of 2 years. So for me, it's very important to get all the snippets of information that I can get. And also adjust my opinion on the topic. Therefore, as I said before, I think from a time horizon that in the short term, there can also be a little more pain to the downside, but the sideways market is the most probable outcome from here on, in my opinion. But over the longer term, 2023, 2024, I still believe that higher oil prices will be the case here, higher energy prices. It's not only crude oil, it's of course natural gas, heating oil, gasoline. So this is my take on here. I can only judge the situation from my approach over the next 2 years, and making calls for 2030, 2040. I'm actually not able to make these calls.
It's hard for us with everything going on. I think it's hard for a lot of us to think about trying to wrap our head around what would be going on that far out. And so if we're in that range and you're playing that range, where do you see it? Do you have a bottom, support and resistance that you're looking at, and what kind of dated contract, what area of the market do you see the most activity, the most opportunity?
Yeah, basically I see many opportunities in markets outside of the energy sector. For example, there are quite some bullish setups in the grain sector. If we look about a chart of oats, for example, or of corn, these look very bullish to me. Also from my setup, this has to be fulfilled. So I'm definitely long these markets right now. As I said before, I'm long the energy market over further time frame in the future. So 2023, 24 contracts. But I think for also the viewers, The grain sector is particularly interesting because the sector is highly affected by the costs of fertilizers. And on the other hand, the price of fertilizers is highly dependent on the price of natural gas, because nitrogen-based fertilizers are produced by natural gas. And basically, if we see a price surge in natural gas prices, we see a price surge in nitrogen fertilizers, and at the end, we see a price surge in grain prices. So important correlation here. And if you think that the energy market is longer term headed higher, then I also think that lots of grains are headed higher in the future. So I think those markets are currently also very correlated, and this will be the case over the next months and years.
And what about metals? Do you look at that space of the commodity market at all?
Yes, I look at gold, silver, copper, palladium, and platinum, where I divide between gold, which I see mainly as a precious metal, as a risk hedge, and I put silver, because of its also industrial use case, more in the industrial metal section, together with copper, platinum, and palladium. Actually, bearish on industrial metals at this stage of the economic cycle. So if we think about that, we will really see a recession in the end of the year or the beginning of 2023, then I don't think it's quite the best place to be here. On a longer term horizon, of course, you could argue again that we need so much copper in the future to get this transition from fossil fuels to renewable energy, that the prices for copper should surge in the future. But in the short term, I don't think it's the best place to be. Also, here's a significant correlation between the LME warehouse stocks of copper and the actual price of copper. We see that inventories are very, very low and are so for, I guess, about 6 months. But copper futures tend to decline in price when these inventories are getting stacked up again. So another correlation that I definitely need to highlight here: if we see a buildup in copper stocks or inventories, this usually leads to price weakness in copper. And all these arguments of a favorable recession and a buildup in copper inventories leads me to the opinion that copper and industrial metals in general are at the moment not the best place to be. I think grains and energy are definitely a place to be, and you also have some soft plays, something like cocoa, coffee, orange juice concentrate, but those are commodity plays that are also highly dependent on container rates. And here we also spoke about the big variable at the moment, which is the congestion at the Chinese ports. So as you can see, the commodity world is also very detailed and very connected on all fronts. And yeah, it's hard to keep a good overview here.
Yeah, a lot of input points. Let's wrap up with gold. What about gold? Because some people, the conditions all around should be fantastic for gold, and yet there's been a lot of disappointment at its performance. Where do you come down?
Yeah, so I'm a big friend of looking gold and compare it with the real yields. And we actually saw a pickup in real yields. So real yields became less negative over the last few months. But gold actually stayed surprisingly stable. Actually, that's like real yields become less negative and gold sells off. But also a correlation that, kind of got broken over the last month, as the US dollar commodity correlation we spoke of earlier. In general, from here on, I use gold solely as a risk hedge, but to play it because of fundamental or technical factors on the upside right now, I really don't see that argument right now. I know this is a controversial topic, but I'm also a big friend of combining gold with Bitcoin, because I'm in the camp that says Bitcoin is kind of the digital gold and the gold for younger generations, if you will say so. Yeah. So this is how
And yet it's been trading in lockstep with the NASDAQ and QQQ. So do you see that? You think it will eventually decouple from the risk assets and trade more like gold? That's your bet?
Yeah, it's kind of my hope, if you will say so. I mean, there are maximum of 21 million Bitcoins that will be mined. So you have top here in terms of supply. Something that you have kind of also in the gold market, because you can just produce or mine that many gold during a year. So there are some fundamental points that are kind of equal, but yeah, Bitcoin is not a tangible asset. It's a digital asset. It's a very emotional asset as well. So there's basically lots of work to do to decouple it from the actual risk asset that it is right now.
Yeah, because right now, as we speak, right, it's down 6%. It's back around 40, despite the fact that everyone's coming off of what was considered a very successful Bitcoin conference in Miami. It confounds those who are in your camp. Why do you think that it is sort of remaining, or its trade seems to be so correlated with the NASDAQ, and it's not trading for all the reasons that you say it should for gold? Emotion, psychology around it?
Yeah, this is, in my opinion, a big part of it. But Bitcoin is basically still a risk-sensitive asset, which is highly dependent on the macroeconomic front. And if we look at the current conditions that we have, risk assets tend to perform very poorly under these conditions. And this is, in my opinion, also the reason why the correlation between the NASDAQ and Bitcoin and risk assets in general is at the moment that high. So yeah, at this stage, Bitcoin is definitely not an asset that has really decoupled from this risk asset status completely. Yeah, but if you look, for example, at fund flows over the last years, where we can see that fund flows decreased into gold as an asset, but on the other hand increased into Bitcoin or crypto as another asset, then you can see that there are some shifts in the market that try to push especially Bitcoin to become a more important asset in this basket. But yeah, it's still kind of a way to go for Bitcoin to become such an asset.
A way to go. So does that mean you buy the dips when you see that it fall with risk assets? Does that make it attractive to you?
Yeah, and as I said before, the current environment is not very supportive for Bitcoin. So I would be careful here at the current stage. But if I see signs of this switching again, for example, liquidity becomes available again into the market, then I think that the Bitcoin crowd and also institutional investors will come back and buy the dip in Bitcoin as well. I mean, this is just another cycle that we see in the market. We see high liquidity, we see higher Bitcoin prices, and we see draining liquidity, and we see lower Bitcoin prices.
Lukas, it was so fantastic to get your thoughts today, and to have you join us. Thank you so much for that.
Thank you, Maggie, for letting me be a part of this great session and be on Real Vision. Really appreciate it.
We'll get back to you again soon and track what's happening with those commodity prices now that we know you follow it so closely. So thanks so much.
Hey there, revolutionaries. To join a community sharing insights like the one you've just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.